Hi, I'm Jimmy. In this video, we're looking at Salesforce, ticker symbol CRM. So we're going to look at the basics of Salesforce's business. Then we're going to run through some of the numbers. And finally, we're going to try to come up with a fair value for Salesforce's stock to see if it's worth investing in today. That being said, let's jump in and look at the basics of Salesforce's business. Okay, now broadly speaking, we can think of Salesforce as kind of the back end for companies. So their service cloud business representing about a quarter of revenue. Well, we can think of this as Salesforce's customer service desk, where companies can track questions, chats, and help customers solve problems faster. Then they have their sales cloud business. This is their traditional business. This represents about 22% of revenue. The sales hub is where it helps the reps follow leads, log deals, forecast revenues, all in one place, kind of a one-stop shop back end for everything sales. Then they have their Salesforce platform. This is about 19% of revenue. And this is essentially a toolbox that allows businesses to build their own apps or automations on top of the Salesforce and chat with Slack while doing it. So trying to simplify the broader process. Integration and analytics. Well, this is how they connect data with their different systems. This is everything data that the company has, which is a ton of data. Then they got marketing and commerce cloud. This is about 14% of revenue. And this is tools for sending targeted emails, ads, or running online stores so shoppers get a smoother, kind of more personal experience. Then we have professional services and other. This is about 6% of revenue. And this is Salesforce's consulting arm that helps customers set up, customize, and ultimately get the most out of their software. So that's the basics of what they do. Then when we jump in and look at where they do their business, well, we can see that about 2/3 of the revenue is generated in the United States. The other third is generated in both Europe and Asia Pacific. So although this is a global business, clearly there's more, let's say a longer runway outside of the United States, since they have a large majority of business in the United States right now. Okay, now let's jump in and look at some of the numbers. Let's kick it off with revenue. And we can see that revenue has climbed fairly steadily for the past few years. This is a 10-year chart, and over the past decade, they've done fairly good. Now, there's been a few different things that have driven that revenue growth. Of course, the kind of automation AI push has helped the business, but through the past decade, they've actually made a few acquisitions. So in 2025, they actually acquired a company called Informatica for about $8.2 billion. Now, this business is designed to help launch their AI push. They recently launched something called Einstein GPT, which is supposed to help kind of all of their customers make better use of their software and try to help automate some of the process, try to make their entire back-end experience a bit better. Informatica is supposed to help them kind of jump up. Now, they just made that acquisition recently, so it hasn't had a huge impact on revenue just yet, but I wouldn't be too surprised if we saw some bump in revenue because of that acquisition. Then in 2021, they actually made a big acquisition for about $26 billion where they bought Slack. Slack is a communication platform that's supposed to help streamline communication within a company themselves and with customers. Now, this is in 2021. This is a big dollar amount that they spent for, yes, there was certainly some revenue that came over, but $26 billion, I think, was an overpay. But again, this has helped contribute to revenue specifically since 2021 when they made this acquisition. Then in 2019, they spent almost $15 billion for Tableau. Now, this Tableau was designed to help enhance their data analytics part of their business. We saw that segment of their business before. This helps contribute to that and help them now. Today, they're using more AI, trying to help customers interact and interpret the data. But I just want to point out, over the past few years, they've made about $50 billion. These are just the big acquisitions. There were a few small ones as well, but these are just the big ones. They've made nearly $50 billion in acquisitions. So going forward, I wouldn't be too surprised if they continued to fuel revenue growth with big acquisitions. But there is another thing to notice about from the revenue chart, and that is revenue growth itself. And I think this is a big part of their story. So here we can see that in the early part of the past decade, well, revenue growth was doing fairly good, right? It was up there in the high 20% range. That's pretty good growth for a company. like Salesforce. It's a decent sized company. It's growing fairly good. But over the past few years, revenue growth has tumbled. Now, I will point out it is still growing. We saw that on the revenue chart. It's just growing. It's decelerating. It's growing less fast than it was before. Now, simultaneously to this, there was actually a big company, Elliott Management, which is kind of an activist investor. And they came on board and said, you guys have to focus more on profitability. We'll look at the profit numbers in a second, but essentially, we need you to be more profitable. And the only way we'll get out of your hair is if you become more profitable. Right now, you're focusing too much on growth. So over the past couple of years, they've kind of made that transition. Now, before we get to profitability, I just want to point out one thing that I think helps us examine and forecast some of their numbers. And that is what they call the remaining performance obligation, RPO for short. Now, if you've ever read through any of their annual reports, you will surely see remaining performance obligation. Essentially, this is their backlog. Now, they have current remaining performance obligation and non-current. Current is essentially the backlog due over the next 12 months. Non-current, typically 12 to 36 months is where they have these numbers. That's according to their own financial statements, 12 to 36 months. Now, essentially, what happens here is that customers come on board and say, okay, we're going to set up this system and we're going to sign up for however long and we're going to pay up front. Now, you might already be thinking, well, how will that affect free cash flow? And I would also point out that on this chart, you can see both current and non-current, so both long-term and short-term backlog, essentially. This is, in fact, trending higher. This is a quarterly chart. This is, in fact, trending higher, which is a good thing. Now, one other minor point to just keep in mind here, but down here, you might notice it says Q1 2026, despite the fact that right now, we're about halfway through 2025. Well, their fiscal year ends at the end of January. So they are already in their fiscal year 2026. So if you see these numbers and they look a little unusual, like, oh, they already finished the first quarter of 2026. Well, their fiscal year, so whatever month the year ends in. So if it ends in January of 2025, that's fiscal year 2025, even though only 1 month of 2025 have come in. So I just want to point that out. If you happen to see that and wonder what's going on or wonder why our forecasts are projecting, 2026 and 2027 numbers and not 2025, that fiscal year is already done. Small point, but just keep it in the back of our mind. Either way, when we're looking at their backlog, we can see that this makes projecting revenue and ultimately free cash flow much simpler when you kind of have an idea of where revenue is going to be. Now, this will be valuable when we jump in and try to come up with a fair value. But now, switching over to profit and thinking about what this company has transitioned to from being a high growth company to now pushing for more profitability. Well, this is their operating income margins. And we can see over the past few years, in 2023, they announced that they were making a big push towards improving their margins, basically getting more profitable, exactly what Elliott Management wanted. And to do that, they laid off about 10% of their workforce. They did a bunch of things they closed some offices. They tried to reduce some, locations, try to consolidate into more affordable locations. They got better deals for some of the real estate properties. Basically, tried to refine the business, which makes sense, which is a smart move. And we can see that had a direct impact on their profitability. But this is crucially important because this is a company that is shifting away from growth. We saw the growth from 20%, down to single digit numbers, away from growth and more towards profitability. And frankly, it's kind of freaked out some investors. We'll look at a chart in a few minutes. But for now, let's jump in and look at net income just to see if the numbers continue to flow through there. And clearly, although they're more volatile than operating profit margins, net income has been volatile. And net income margins, as you might guess, has also been volatile. But the past couple of years, it's looked fairly good. So I think that this is a positive sign from a company that has explicitly stated that they want more profitability. Along those lines, Now we jump in and look at free cash flow. So this is their free cash flow numbers going back the past few years. And clearly, this looks good. Now, obviously, this is ramping up faster than what we saw with revenue. Free cash flow will grow faster. And this goes right back to essentially their backlog. If customers are signing up and prepaying for the year, well, that revenue and profit does not get recognized until they earn it, but the cash flow does get recognized. So that is why we see the big jump in free cash flow. And also in line with that, and in line with their recent shift away from focusing more on growth and instead focusing more on profitability, well, we can see a very, very similar story when we look at free cash flow to revenue. And this, as you can see here, this story is very similar to what we saw with net income or operating income profit margins, where, okay, they're generating per dollar of revenue, per $100 of revenue, they're generating more dollars of free cash flow, which kind of makes sense. They're trying to become a more efficient company, and we are likely to see that carry through into free cash flow. Now, before we jump in and look at the fair value, I just want to point out that in their transition from a growth company to a, let's call it a profitability company, they've also tried to get more investor friendly. So first, let's jump in and look at their shares outstanding. So we could see for a while they were increasing the shares outstanding. This was happening for some from share issuances, some of it tied to some of the acquisitions that they were making. Also, employee stock options, some of that was fueling additional share growth. But over the past few years, we could see that shares outstanding has begun to tick lower. So they have started to buy back some stock. Along those same lines, when we jump in, again, we're on the Investors Grow website here. But when we jump over to the Investors Grow website, this is a decade-long chart. For a long time, they didn't pay a dividend. Just recently, they started paying a dividend. From a percentage basis, it's not that big. But if we are an investor, or if we're considering investing in this one, it's nice to know that they're both buying back stock and also started paying a dividend. So that could be something to keep in the back of our mind. Now let's jump in and look at free cash flow estimates and then try to use these numbers to see if we can come up with a fair value for Salesforce's stock. So first, this is the free cash flow estimates that we have on the Investors Grow website. And essentially, you can see analysts have free cash flow numbers ramping up a decent amount. Everything we're seeing from the increase in the backlog that we saw, the continued increase in revenue, the continued improvements that they've made to the efficiency of the company, which they claim they expect to get at least somewhat better from where it's at now. All of those signs point to a decent amount of free cash flow over the coming years. So I do not believe at all that these numbers are unreasonable numbers. And if we take just these numbers and then we assume 2.5% growth, just, standard about the cost of inflation growth after this time period, well, we end up with a stock that looks significantly undervalued compared to the current price. Using those free cash flow estimates, we end up with a fair value of about $327 per share. Considering the stock's trading at about $260 per share, the stock looks reasonably undervalued. So the question is this worth investing in today? Now, this stock has seen a decent pullback from its highs over the past year. In fact, our fair value is at 327. It's not even at the top of where this chart was over the past year. So do I think it's possible that this company gets back to that level? I do. But I believe that one of the issues that this company has faced over the past couple of years is the expectations that this company was going to grow. So where they were growing at like 20% a year for a few years there, as far as revenue is concerned, well, we've seen that number come down a decent amount. I'd be impressed to see it get back up there without some sort of major acquisition kind of tilting the numbers a bit. But even with that, I would expect for growth to be more modest, but now profitability to stand out a bit more, just like the company's been pushing for. So I do believe over the next few years, it is likely that it's very possible for Salesforce's stock to recover to be about where it was from a fair value perspective. Again, climbing up this chart about 30, 40% higher than it is today. So for me, on a personal basis, I got two different portfolios. I have a high quality portfolio where Salesforce, I think, would fit very nicely into that portfolio. As far as my long-term buy and hold portfolio, I think I'm going to hold off there, but I do plan on adding this one to my high quality portfolio. Now, as is my personal rule, I will wait a few days after I release this video. I'll wait a few days so everybody has a chance to do their own research, see if it's this company that they're interested in investing in themselves. I implore you to dig in, look at the numbers, pay attention to where management claims that they want to go over the next few years, see if you agree with them. I think it's very possible, despite the fact that they are the number one company as far as the total addressable market right now. So I do think that they're somewhat limited from a growth perspective. But from a profitability perspective, I do think that there is some upside. And I think the more that happens, the more likely it is that this stock recovers. So I plan on adding this one both to my bullpen and also to my high quality portfolio, at least a few days after I release this video. Now, if you'd like to learn how to research stocks or sign up to get access to the Investors Grow website, I have links in the description below for both of those. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.